Okay, welcome everybody to CC Live at World of Concrete. Hope you're having a good time and having a good show. One highlight of World of Concrete every year is listening to Ed Sullivan give his annual forecast for the cement and the U.S. construction industry. And we're lucky enough to have him with us here today. And we're going to learn a lot about what we could look forward to for the year ahead. Ed, what are some of the impacts we should be looking forward to and some of the data? How does it look for the next year and the future after that?
Well, so far, things look very firm. There are some risk factors. One is obviously the price of oil and what kind of an impact that has not only in the specific oil drilling industry, but also in the collateral industries that support that industry. So that's one big one. There is some concern about non-residential construction and recent data that's come on about that we're paying attention to. Right now, we don't think it's a huge problem, but it's something to pay attention. And thirdly, I think you can point to the potential disruptions to the U.S. economy and construction market that might originate from outside our borders. And so what I'm talking about is the potential continued decay and growth in China and some of the emerging countries, and the potential that holds for potential defaults, not only oil defaults, we're talking potential of hundreds of billions of dollars, but also the added risk that's attached to foreign sovereign national debt. So those are some things that could come back. I don't think there's real concern at this point. The fundamentals supporting strong construction activity this year remain in place. And so we think it's going to be a pretty good year for us this year.
Okay. Specifically, what are we looking for as far as cement consumption? Where were we last year, and what do you see for the next year or two?
Well, you know, last year we expected the market to grow 8%, and it didn't. Again, culprit, oil is one of them. The second is that the housing starts were, again, stubborn against stronger growth. And thirdly was a decay in a thing called cement intensity. How much cement, how much concrete you use per ton of construction activity. And that had an outright decline, and that pulled down the growth rate considerably. But look, as we change and go forward, there's a couple other issues to consider. In that forecast, we did not have the new FAST highway bill in there. That will add some strength. And again, you know, the economy, particularly the labor markets, have shown tremendous resilience, and that's critical for the foundations that are going to push construction activity this year.
Okay. The economies of the world are more connected than ever, and China, while it's still growing, is not growing nearly as much as it was a couple years ago. How does that trickle down to the United States, and is that a concern for us?
It's not a direct assault on us, or it's not a direct issue. But look, we do export some goods to China. They obviously export more to us. To that extent, our exports will be hurt. In addition, one of the reasons why we have this low oil prices is because of the decay in growth in China. And thirdly, it can potentially, they could contribute to a debt issue that could leak into added risks in terms of loans, etc. Again, I think you have to create quite a long story to get there and to say that that's going to be a significant impact on construction. But it's there, but I don't think it's a very strong impact.
Okay. The lowering of oil, I'll call it the collapse of oil prices, does it have a negative effect or a positive effect on the U.S. economy and construction? What do we look forward there?
It has both. And when you look at oil prices and when they decline, I think what you have to do is take a look at a time horizon. in the very near term, when oil prices decline, the guy who's drilling the rig says stop, and he lays people off. And people in that area, there's no more reason to build that new retail shop or that apartment building or that office building. That collapses immediately.
Okay.
It's a negative drag on the economy. But stop. Every one of us in this room will stop at the pump, fill up, and we see how much cheaper it is. Again and again and again. And eventually, that will translate into increased consumption activity. That boosts overall economic activity. And with a stronger economy in general, well, you can argue that that will impact and have a stronger construction industry. Again, the impacts are delayed. Minimal impacts this year, maybe some more in 17, and those impacts will be watered down because there's so many things that have to happen in order for it to finally have an impact on construction.
So it sounds like the oil prices would have to stay down for a long period for it to really trickle down to the more meaningful impacts like construction, which we're all interested in.
That's true, but we will see some positive impacts on the economy later this year and into 2017.
Okay. And what do you see each of the major sectors doing in the near future? Residential, non-residential, and public construction?
So if you look at the residential, there's a couple of issues on that one. Number one is it's stubborn. It grew from 1 million starts to 1.1 million starts in 2015. 10% growth.
Right.
But percentages lie, because even though that's a 10% growth, that compares to over 2 million starts when we were at the peak and the boom. So it's still very weak in state. And some suggest that at this point in a recovery, why isn't it stronger? I think there's a couple of issues. Number one, let's look at that first-time home buyer. They are the foundation upon which demand at every other level leading up to that rests. That's the millennials. The millennials are a generation that saw their parents or friends of theirs lose homes. They don't buy into that whole story that I bought into when I was growing up, is that's the best way to invest and gain equity. Number two, millennials, some of them are just overburdened in student debt. We're not talking just a few thousand. Some are in excess of $100,000 in debt. They are buying their home, and it's going to fund their student debt. And so they go into multifamily. Third, the recession, a lot of people lost their homes. A lot of people declared bankruptcies. That's 7 years. And under tight credit conditions now, they still have a hard time to show that they are still players. So there's a lot of reasons why the demand is still not percolating. Now, that's a national perspective. Regionally, you can see some areas that are hopping. You can look at San Francisco area or what was areas of Texas until recently. And what you see, and there's some suggestion, that there are labor shortages that prevent us from achieving the kind of starts activity that you would normally expect. Now, we estimate that nationally, that accounts for 75 to 125,000 homes. That's a lot of cement. That's a lot of consumption activity that's foregone because there are some labor shortages.
Okay. Well, labor shortages is something else I was going to ask about. Everyone here at World of Concrete, whether it's the contractor with people vibrating the concrete, ready-mix producers are having trouble finding truck drivers. Is that dragging on the construction in the United States, and how far out do you see that problem staying with us?
It absolutely is throughout our industry. The last recession was construction-centric. We lost 30% of all workers during that recession. And think of it, if you're caught in the middle of that, in that long, harsh downturn and you're near retirement, you got out. We just lost some skills. You retrained if you weren't old enough to retire and you went into a new industry. 500,000 Mexican-born workers went back home. We also looked at what happened in high schools. We cut shop class. We cut apprentice programs. And so what we're seeing is the exit of people, but no pipeline to bring them back in. I think there's a lot of people, millennials or what have you, who suggest, hey, I'm not going to go into a trade. I'm going to go get my job. I'm going to go rack up $150,000 in debt, and I'm going to graduate, and I'm going to sit on my dad's couch, because that's what you're going to get, rather than get into trade where you can't actually do very well right now. There are shortages, and it impacts what we're seeing most is in the residential side, but it's evident in the non-residential side and the public side as well. Not quite as severe.
Okay. And finally, what are you looking forward to as far as oil prices affecting the price of asphalt? It seems to me the price of asphalt should have come down a lot with oil, but it really hasn't, has it?
No, it has not. We've done a lot of studies when oil prices were climbing and asphalt was climbing, and we looked and we said, hey, look at concrete, certain depth. We can compete on an initial cost and a life cycle cost bid with asphalt. And then we saw oil prices tumble. And that strong correlation when oil prices rise and asphalt prices rise didn't hold on the downside. Because look at it. Oil is a factor cost. It's an input into making it. But there's other factors that determine the price of asphalt. And there's still paving. And there's still a market out there. And there is some reduced supply out there because of cokers, etc. So if you look at it, the decline in oil prices compared to the decline in asphalt prices, it's minuscule. PCA believes that right now, the relative cost of concrete to asphalt is still competitive, even at these lower oil price levels.
Okay. And finally, the stock market just came off of awful January 2016. Does that forecast a possible recession or trouble ahead, or is that just a blip and will the consumer still spend after losing a lot of money in their portfolios?
I think sometimes there's a disconnect between what happens on Wall Street and what happens on Main Street. So if you look at one issue that I know is going on, and that is with the decline in oil prices, and you are a Middle Eastern country, we'll say Saudi Arabia, and you still, for a lot of political reasons, are going to continue to amp up public construction, public programs, etc., then guess what? With oil prices down, you've got to start converting some of your other assets, petrodollars, bonds, etc. So when they start to sell that, that will flood over into our financial arena, stock market, etc. And that will be a burden that the market's going to have to bear. But if you look at the longer, or from an economics point of view, Main Street, as long as we continue to generate in excess of 200,000 net new jobs monthly, guess what? Our economy is going to be doing pretty good, and so is construction. For every person you hire, you just hired a taxpayer. And that means state and local governments do very well. Out of every million workers you hire, 200,000 of them are office workers. That means vacancy rates decline, and leasing rates increase, and the expected return on investments increase. And that happens across the board for non-residential properties. And then finally, to the extent that you continue generating jobs, the risks of me lending money to you are lower, and it makes it easier for people to get access to mortgage credit, etc. So as long as that job market continues to generate 200,000, the fundamentals for construction should remain in place. There's a dichotomy, there's a difference between what happens on Wall Street and what happens on Main Street. And right now, we're pretty confident that Main Street looks okay.
So it sounds like jobs is really what it's all about for a lot of the people here.
It is.
It drives a lot.
And that's been the key equation last year as well. Now you keep in mind, the complexion of that changes. Because here's what's happened. You know, when we started our recovery, we depended upon areas that weren't so severely wounded by exotic mortgages. We were dependent upon growth in energy, in ag, in the markets that weren't as impaired by the recession. We were dependent upon the central portions of the United States. And now look at what's happened. Ag is hurting because the international export market is weaker. The dollar is strong, not only hurting ag, but hurting manufacturing. And thirdly, now we have the oil decline. What you've just described is three key areas why that central portion of the United States is now not going to be the growth pusher. We're going to increasingly depend upon what happens on the coasts. And the issue and the question becomes is, have those economies healed enough so that they can shoulder the burden of growth going forward in 16 and 17?
Well, overall, it sounds like we're in a pretty good spot for 2016, although there is an issue or two nipping at our heels, right? Is that how
It is.
Was that pretty good
You know,
summary?
we have a forecast out there that we performed in November, and it'll be updated in March. Now, we're saying 5% growth this year and a little bit stronger in 2017. We'll make adjustments to that. My guess is those will be small downward adjustments. It's not going to change the flavor. We're still saying that, look, we're in good, solid growth area that'll continue in 2016 and probably next year as well.